In the United States, owning a home is marketed as the ultimate symbol of success, stability, and freedom. It is the cornerstone of the American dream. We are told from a young age that renting is throwing money away and that a mortgage is an investment in our future. But behind the white picket fences and the polished real estate brochures, there is a mathematical reality that most homeowners are never shown. The 30-year mortgage is not designed to help you own a home. It is designed to ensure the bank owns you for the most productive decades of your life. Most Americans don't just pay for their homes, they pay for them too, sometimes 3 times over. This isn't an accident. It is a calculated, engineered transfer of wealth from your pocket to the financial institution's balance sheet. Today, we reveal the truth about why most Americans overpay on their mortgages and how the system is rigged to keep you paying until the very end. 1. The 30-year illusion. Selling monthly payments, not total cost. The primary reason Americans overpay is the way the product is sold. Banks do not sell you a $300,000 loan. They sell you a $1,800 monthly payment. By shifting the focus from the total cost of capital to the monthly affordability, the industry masks the staggering price of interest. When you sign a 30-year fixed-rate mortgage at 7%, you aren't just paying back the principal. Over 3 decades, you will pay back the original loan plus an additional amount in interest that often exceeds the price of the house itself. Most homeowners focus on the price of the house, ignoring the fact that the cost of the loan is the real product they're buying. The system relies on your inability to see 30 years into the future, keeping you focused on whether you can survive until next month's bill. 2. Front-loaded interest. The amortization trap. The most predatory aspect of a mortgage is a concept called amortization. If you look at your mortgage statement during the first 10 years, you will notice something terrifying. Almost none of your money is going toward the house. The system is front-loaded. In the early years, your payments are almost entirely interest. You're paying the bank's profit up front while your equity remains stagnant. This is a deliberate strategy. Banks know that the average American moves or refinances every 5 to 7 years. By front-loading the interest, the bank ensures they collect the lion's share of their profit before you ever have the chance to pay down the principal. You are essentially renting the house from the bank while bearing all the costs of maintenance, taxes, and insurance. 3. The refinance treadmill. Starting the clock over. Wall Street loves when interest rates drop, not because they want to save you money, but because it triggers a refinance wave. Homeowners are told they are saving $200 a month by switching to a lower rate. What the loan officer won't tell you is that by refinancing into a new 30-year term, you have just reset the amortization clock. You are back to square one, paying front-loaded interest all over again. Most Americans fall into the refinance treadmill, resetting their 30-year clock every few years for a small monthly break. They spend 20 years paying for a house and still have 28 years left on their loan. It is a cycle that ensures the mortgage is never actually paid off. 4. The escrow and insurance black hole. Overpaying isn't limited to interest. The PD structure, principal interest, taxes, and insurance allows banks to control your cash flow through escrow accounts. Banks often overestimate the required escrow cushion, holding your money interest-free while they manage your property taxes and insurance. Furthermore, most Americans are overinsured or stuck with private mortgage insurance, PMI. PMI provides zero protection for the homeowner. It only protects the bank in case you default. Yet, millions of Americans continue to pay hundreds of dollars a month for PMI, long after their home value has risen, simply because the bank isn't required to automatically remove it until you reach a specific, often outdated, equity threshold. 5. The psychology of the tax break. One of the greatest marketing lies ever told is that the mortgage interest deduction makes debt a good thing. The government and the banks have teamed up to convince you that paying $10,000 in interest to save $2,000 on your taxes is a win. This is a psychological trap. You're being incentivized to stay in debt. The deduction only benefits those who itemize. And for the vast majority of middle-class Americans, the standard deduction is more beneficial. You're overpaying for a house based on a tax benefit that often doesn't even apply to you, yet the myth persists because it keeps people comfortable with carrying massive debt loads. 6. Opportunity cost, the wealth you never build. When you overpay on a mortgage, the cost isn't just the dollar amount of the interest. It is the opportunity cost. Every extra dollar sent to a 30-year amortization schedule is a dollar that isn't being invested in assets that actually appreciate or provide cash flow. If the average American took the extra interest they pay on a 30-year loan and invested it into a simple index fund over that same period, they would retire with millions. But the system is designed to keep your capital locked in a non-liquid asset, your home. The bank uses your interest payments to build their wealth, while you are left with home equity that you can only access by taking out even more debt via a home equity line of credit. HELOC. 7. The real estate agent and bank synergy. The entire real estate ecosystem is incentivized for you to overpay. Agents are paid a percentage of the sale price. The higher the price, the higher the commission. Banks are paid based on the size of the loan. The larger the debt, the more interest they collect. No one in the room when you sign your closing papers has an incentive for you to buy a cheaper home or a shorter-term loan. They want you at the maximum of your DTI, debt-to-income ratio. They push you to the edge of what you can afford, knowing that once you are in the house, you are trapped. You become a captive annuity for the financial system. 8. How to break the trap, the counter strategy. To stop overpaying, you must stop thinking like a homeowner and start thinking like a debt manager. 1. Bi-weekly payments. By making half a payment every 2 weeks instead of a full payment once a month, you make one extra full payment a year. This alone can shave 5 to 7 years off a 30-year mortgage and save you tens of thousands in interest. 2. Principal-only payments. Every extra $100 sent specifically to the principal in the first 5 years has a massive 30-year compounding effect. It kills the interest before it has a chance to grow. 3. The 15-year rule. If you can't afford the 15-year mortgage, you can't afford the house. The interest savings between a 15 and 30-year term are astronomical. 4. Challenging assessments. Most people overpay on property taxes because they never challenge their local government's assessment. Conclusion: freedom is not a 30-year loan. The 30-year mortgage is a financial product designed to extract the maximum amount of wealth from the American middle class. It is the trap in the mortgage trap. It turns a shelter into a liability and a citizen into a debt servant. But knowledge is the first step toward the exit. When you understand that the bank is not your partner, but your creditor, you can begin to make decisions that prioritize your net worth over their profit. If you are ready to stop overpaying and start building real wealth, like this video to spread the message. Subscribe to The Mortgage Trap. Turn on notifications for our weekly deep dives into the financial system. A house should be a place where you live, not a place where your wealth goes to die. Stay vigilant. The system is designed for you to pay. We are here to help you win.